All right. Thank you, everyone, for joining us today for this SSQ Insurance webinar with Fisher Investments. We're very excited to have them here. And we have Aaron Anderson and Owen Mielfield. And I'll pass it over to them to introduce themselves in a second. Just going to go over a quick housekeeping items. If you do have any questions or any comments, feel free to participate. You can ask them in the Q&A section or in the chat box. And at the end of the presentation, we'll have a kind of little Q&A session where Owen and Aaron will answer any of your questions and kind of discuss some of those things that they've gone over a little bit more in depth. From SSQ, we do wish you a happy new year, and we're excited that you've joined us here today. And without further ado, I'll pass it over to Owen.
Great. Thanks, Stephen. I hope everyone can hear me okay and see me okay. So again, my name is Owen Mielfield. I'm a vice president and portfolio specialist within our institutional group. I'm joined today by Aaron Anderson, who's the senior vice president of our research team and is also a member of the 5-person investment policy committee, which manages both the emerging markets equity and global small cap equity strategies that we currently run on your platform. So I'd like to start by first thanking each of you for the relationship that we have with SSQ, and we're delighted to showcase our capabilities for each of you today. And as Stephen mentioned, if there are any questions or resources that we can, questions we can answer or resources we can provide along the way to help you better communicate our capabilities to your clients, we are delighted to assist any way we can. So as Stephen's brought up here on the slide, Fisher Investments is a US-based global equity manager. We originally founded in Woodside, California, which is a suburb of the San Francisco Bay Area. But over the years, we've been in business since 1979. We have grown considerably over time and have expanded our reach to be a truly global organization. With offices not only in California, Washington, Texas, and now Florida in the United States. We have facilities in London, Dubai, Sydney, Tokyo, and Dublin overseas. So truly a global organization, which is very much the way we think about investing. So I use the word global in that we have a top-down global research structure, and top-down approach to investing, which is quite unique and differentiates us from many of our peers that would execute their investment portfolios via more traditional bottom-up techniques. And so as I go through the coming slides, keep in mind that one of the unique ways to position Fisher Investments is tied to our top-down views, which Aaron will discuss in far greater detail later in the presentation. But do keep that in mind as you communicate with your underlying clients. And so, Stephen, if you move forward to the next page, just a quick overview of the firm. This is as of November 30th. As of year end, we closed the year at over $200 billion. In assets under management for clients. Over $60 billion of that is institutional clients as of year end. I mentioned that it is a global research platform. We have north of 3,000, closing in on 4,000 employees across the world. We are independently owned and solely focused on asset management as our core business. So we exist to deliver exceptional returns and service to our clients. We've been an exceptionally stable organization. We have many employees. Aaron and I are great examples of that have been with the firm for a very long period of time. And I'll talk a little bit about the decision-making team here in a moment. But we've had a very stable decision-making structure and leadership structure at the firm for a long time. And so, Stephen, if you can move forward to the following page, here's just a quick overview of our Canadian institutional client business. So we currently manage right around $2.5 billion in assets for 15 different institutions encompassing now 34 mandates. So many of our clients have employed us in multiple areas of the portfolio. So including the team here at SSQ, where we currently manage emerging markets equity and have for nearly a decade. And then more recently, Global Small Cap was added to the platform in 2019. And upcoming here in the next few weeks, we're getting ready to launch our United States Small Cap Equity ESG strategy, which should be available here very soon. But you'll see some of the most prominent Canadian institutions would be our clients. So this is just a sample list of the types of folks that work with us. We have several large pension funds that do not grant written name use, but Hydro-Quebec being one that allows us to share their name verbally. And then we have some others as well, which we manage money for that do not allow us to show the name on the list. As you move forward to the next page, talking about the decision-making structure of the group. So Aaron Anderson, who's with me today, is one of 5 members of our investment policy committee. He's joined by our co-CIOs, Jeff Silk and our founder, Ken Fisher. Ken and Jeff have worked together managing portfolios for our clients since the 1980s. Aaron and Bill and Michael Hansen have all been longtime members of the research team. Bill and Aaron have been on the committee for about a decade. Michael's been on the committee now for several years as well. But they are supported by a very deep team of investment professionals. We have north of 90 investment professionals at the firm today. And on the coming page, I'll talk a little bit more detail about the core research team. So we currently have, I believe it's 51 is the present headcount, research analysts supporting Aaron and the other members of the investment policy committee. And we've broken this research function into 3 different types of analysts. And if you think about us having a top-down investment process where we extract excess return for clients from both top-down factors, so our country, sector, size, and style decisions relative to benchmarks, but then again also via bottom-up stock selection. And the securities team, we've organized our research resources to provide information to the investment committee from those multiple vantage points. So the capital markets research team covers countries and sectors from a top-down perspective, helping the committee identify where we are in the market cycle and what implications that may have for relative category returns. The securities research team, as the name might imply, these analysts conduct bottom-up company-level research, and they cover, in most cases, global sectors or industry groups, depending upon the security count within those categories. And then we also have a third team of research analysts, which we call our capital markets innovation team. And think of these folks as being more quantitatively driven. They assist the investment committee with a couple of different types of research. So some of it is risk-based modeling. So attribution analysis, factor analysis, factor risk analysis to mitigate unintended risks within our portfolios. And then they also help with theoretical work. So if we want to test, let's say, portfolio sensitivity to a factor like interest rate volatility or currency fluctuations, they'll work with the big data sets to identify which of our ideas can be supported by fact-based data research. And so if you move forward to the next page, you'll see a broad distribution of our institutional business and the types of strategies that we manage for clients. Currently we have US large and small cap strategies, global large and small, international large and small, and then emerging markets large and small. Regardless of the category that clients are asking us to focus on, it is the same investment team utilizing the same investment top-down investment process. We're simply applying our ideas and our current research to the category of equities that clients have asked us to specialize in. So today we're going to focus primarily on the emerging markets product, which we, as I mentioned, we've managed for about 10 years for SSQ. And then also our global small cap strategy, which we started managing for you a couple of years ago. And with that, I'm going to turn things over to Aaron. He's going to take you through a little more detailed version of the investment approach. And then I'll come back in to discuss our performance history. And then I'll turn it back to Aaron to really kick off the discussions with our current market outlook.
Thanks, Owen. And as Owen just showed you, we manage a number of different flavors of global equity strategies, but really they all utilize the same global research platform, the same investment process. It's just a matter of taking those views and then applying them to different categories of equities. So I want to dig a little bit into that investment process and explain how we do it. If you look at page 9 here, it's just a basic funnel, but really what we're trying to describe here is how we look at these large universes of equities. As an example, global small caps have thousands of companies you could invest in. Same in emerging markets. I think practically no investment manager is doing in-depth ongoing research on every single one of those companies. Every manager has got a process for trying to focus their attention in on some subset of those equities that they think is going to be most fruitful or that suits their investment process best. But the way we go about doing that is very different than other managers. And I think one of the things that really sets Fisher Investments apart. Many managers tend to focus on a particular type of equity all the time. Value managers are looking for cheaper companies. Growth managers are looking for faster growers. You've got small cap managers. You've got quality managers. Most managers narrow the universe by imparting some permanent bias on a portfolio. And there's nothing wrong with that per se, except that we know that any of those types of characteristics, growth, value, big, small, high, low quality, any of those can go in and out of favor, sometimes over very significant periods. I mean, we've been through years and years now where growth stocks have outperformed value stocks. And that's not to say that value managers are bad managers. It's not to say that value stocks won't have their day in the sun here eventually. But it just goes to show how significant and how long lasting some of those headwinds can be. We take a very different approach. We want to be much more flexible in that regard, and that both of the strategies that we manage for you currently, as well as the small cap strategy that's upcoming, are all core strategies, but at any given time, they might have a tilt, sometimes towards growth, sometimes towards value, sometimes towards bigger parts of their universes, sometimes towards smaller, et cetera. We think not being permanently focused on a particular type of equity, but rather having the flexibility to orient our portfolios towards whatever types of equities we think are going to do best in the period ahead of us. That's the key to more consistent success over time. It shouldn't matter so much if we're in a bull market or a bear market or a growth or value-led market. We should be able to navigate all those parts of a market cycle well, so long as we're making good decisions, of course, but there's no permanent preference that we have that means that we face some significant performance headwind at periods where that particular type of equity might be out of favor. And I think that's particularly relevant today because what I see with investors now is just looking at how well the larger, higher quality growth companies have done to this point. They're afraid not to own those companies because they have been such a key driver of return. But just as common are people who are afraid to own those, who think that maybe we're in for a leadership shift, maybe value stocks and smaller stocks are ready to take over better performance. And so I think it's important that a manager has the flexibility to emphasize whichever type of equity they think are going to do best in the period ahead. But like other managers, we also want to focus our attention. We're not asking our analysts to go out and analyze every single global company. We cover a lot of them, of course, but we use our macroeconomic analysis to help focus our attention. The first thing that we want to do is look at the global macroeconomic environment, and we're trying to identify macroeconomic conditions that we think will turn out differently than others do. If everybody expects all this quantitative easing and monetary policy measures and so forth is going to drive a lot of inflation in the future, and they bake that expectation into equity pricing now, if we think that that is going to turn out differently than most do, we can use that information to help point us into categories of equities that are better suited for the environment that we see going forward. And we should be able to capitalize on that through some of the top-down decisions that we're making in portfolios. So the first step is really to identify those macroeconomic themes where we think we've got a differentiated view that we've got a lot of conviction in. We then decide how that's going to influence the allocation decisions we make within our portfolio. So what countries or sectors or other categories do we want to be overweight or underweight to? Then by the time we're doing our individual security analysis, we're doing it in very focused areas rather than saying to our securities analysts, just go find us some good global small cap equities or emerging market equities or US small cap equities. We're saying to them, our macroeconomic analysis has suggested we want exposure to this particular category. Maybe it's industrial machinery companies. Let's really focus our attention there. It enables our analysts to do in-depth, robust analysis on that more manageable group of companies, and then ultimately enables us to add value through the security selection part of the process as well. As Owen mentioned, ultimately, we're aiming to add alpha to the portfolio through all of those decisions, through the macroeconomic themes we try and emphasize, through the allocation decisions that derive from those, and then ultimately from the equity selection as well. We feel very strongly that that creates a more complete investment process that's accounting for all the forces that impact equity pricing, and also diversifies our alpha stream by providing multiple sources of alpha generation as well. Now, if you go to the next page, this just gives you a sense of some of the factors that our top-down macro-focused analysts will be paying attention to. You can imagine in conducting global macroeconomic analysis just how much information there is there. Literally in any month, quarter, year, there are hundreds to thousands of different economic data points, political events, sentiment measures that we could be focused on. And that's how we tend to categorize things. We ask ourselves, what's the economic backdrop like for different countries, sectors, other categories of stocks? What's the political environment like for those? And then maybe most importantly is how does all of that compare to investor sentiment? We very much have a view that what drives equity pricing is how reality plays out relative to investors' expectations. And so what we're looking for, as I mentioned before, are areas where we think we've got a view that's different than the consensus does. And when we can identify those, to us, that's the most exciting opportunity. And here we'll have ESG considerations as well for our strategies. And we tend to look at ESG from both a top-down lens as we're looking at the ESG practices of governments, we're looking at labor relations, we're looking at social issues, as well as from the bottom up, looking at companies where they're sourcing their goods, looking at their diversity and inclusion programs and so forth. And not only can that help just add a more positive ESG profile to a portfolio, but can help you avoid ESG-related risks like environmental regulation changes and so forth, but also identify new ESG-oriented opportunities for growing areas like alternative energies and so forth. Now, if you look at the next page of the presentation, this digs into the bottom-up part of the process. So once we've identified a category that we're interested in, that view tends to get fairly granular. We're looking at industries, sub-industries within specific countries or regions. So right off the bat, that top-down part of the process serves to focus our analyst attention in on a very specific category. And as we look at the equities that make up that universe, the first thing that we do is apply some risk control screening. You see it listed there as liquidity and solvency screens. Basically what that means is we're not interested in companies that don't trade enough or we can't buy and sell them without having a big influence on the equity price. So we've got some minimum liquidity standards that our companies have to meet to be included in portfolios. Similarly, with solvency, what we mean here is we're just not the type of manager looking for highly distressed companies that might turn themselves around and do very well, but also pose some outside bankruptcy risk. So we've got a lot of flexibility in terms of emphasizing stronger or weaker balance sheets, but we never want the real weak ones. We want to generally be focused in on higher quality companies to lower that insolvency risk. For an ESG strategy, we can also imply some ESG preferences here as well. If there are certain categories of equities, like maybe tobacco-oriented companies, like munitions producers, that for an ESG-focused strategy just aren't well suited, we can screen those out at this phase of the process as well. Beyond that, what we're trying to find are companies that act like the category that we're interested in investing in. We want the companies themselves to have some unique characteristics that allow them to stand out relative to their peers, and we want to pay a reasonable price for them. So you see a step there that's labeled outlier analysis. What we mean by that is sometimes you get a company that's classified one way but acts another. Imagine a software company that sells entirely into the energy sector. Might be classified in the technology sector and the software industry, but really it acts a lot more like an energy company because that's its sole end market. Might be a perfectly fine company, but if what we're looking for is more pure technology and software exposure, that might not be the company that we want to own because it's less likely to give us our desired exposure within the portfolio. And so we're looking at the operational history of companies, we're looking at the equity performance history, and we're tending to screen out those companies that don't give us confidence they're going to act like the category we're looking to invest in. This is when our securities analysts would really be digging into the companies in a more in-depth way. They're essentially gathering qualitative and quantitative information about these companies. You see some examples of things they'd be looking for over there on the right. Does a company have a strong brand name? How is its balance sheet structured? What is its distribution plans? Does it have some proprietary technology? What are its ESG characteristics and so forth? Once they've gathered that information on all the companies that we're considering, then we can start to pass judgment on them. We can say to ourselves, which companies have got the attributes that look more desirable for the portfolio? And that helps us sort through this universe and try and identify the companies that are best positioned for the way we see the environment evolving going forward. We essentially then do an assessment of management as well, where we ask ourselves, has management done a good job capitalizing on these attributes? And are they pointing the company in the right direction going forward? And then we bring in valuations. And from a valuation standpoint, really what we're trying to ensure is they're not paying too high a price for a company. We're not just defaulting to the cheapest companies here. Sometimes companies are cheap for very good reasons, but we want to understand any relative valuation premiums or discounts relative to other companies, relative to a company's history, and feel comfortable that those are warranted if indeed we are deciding to invest in that company. Lastly, we have a checklist that our analysts go through to look for operational risks, ESG related risks, and so forth, simply so we can be aware of those. Doesn't prevent us from owning a company just because some of those boxes might be checked, but we want to know about them ahead of time. Every company that makes its way into the portfolio goes through this level of rigor before we ultimately make an investment decision. Now, if you go to the next page of the presentation, I mentioned that we can look at the ESG factors through multiple lenses. One is from a top-down perspective, but more traditionally, ESG is done more from a bottom-up. So here you just see some examples of different ESG-related factors that we would be paying attention to. From an environmental standpoint, we're looking at things like biodiversity, supply chain management, water stress. And we're not only trying to avoid bad actors here, but also looking for opportunities to add companies to portfolios, particularly ESG-focused portfolios that have got a more positive ESG profile. Well, we've got other similar factors we can look at from a social standpoint. And then governance, of course, is always a key consideration. Even beyond thinking about ESG, governance of all these factors is probably the one that has the biggest link to actual financial performance. And so we want to do robust governance analysis there as well. Now, I'm going to pan things back over to Owen so we can talk a little bit about performance and positioning, and then I'll jump back in as we get into our outlook.
Great. Thanks, Aaron. So, Stephen, if you go to the next page or the next several slides, we'll speak to the historical performance for both the emerging market strategy as well as the global small cap strategy. I think one of the things that you'll find is that both opportunity sets offer inefficiencies that we have been able to successfully exploit to the benefit of our clients for a very long time. So emerging markets equity, I know we've been managing for you since 2011, but our first clients in this space date all the way back to 2006. And you'll see that in both the more recent term and over the longer haul, we've been able to consistently provide excess performance for our clients. And again, to Aaron's point, we've been able to do so with what I would consider a diversified stream of alpha sources or excess return sources. So some of this comes from our ability and history of making country allocation decisions. Some of it comes from our sector allocation decisions, and while still getting a meaningful component from our bottom-up stock selection within the categories. So we certainly believe that relative to peers, we are able to offer a more consistent and diversified source of alpha. And that is not particularly style dependent, right? In more recent years, and Aaron will talk a little bit more about the way we're positioned today. In more recent years, it's been tied to our preference towards higher quality growth categories, whether it be in emerging markets or in the global small cap space. But in other parts of the market cycle, it may be tied to tilts towards defensive or tilts towards smaller, more value-oriented type companies. It can be informed by our views on one country or one region within either choice set relative to the others. So there's a very nice story that you can tell with your clients in terms of being a nice source of additional returns, a place where active management can be deployed successfully over the long haul. And so, again, here we're looking at EM, and then on the next page, global small. But, in 2020, both portfolios would have performed roughly in the mid-teens percent over what the benchmarks provided. And, so again, very consistent results for a long period of time. As you go into the next section, you can take a look at the way the portfolios are currently set up. So first, looking at emerging markets equity. Right now, we hold about 55 names, and some of the characteristics that you'll want to note is that right now we have a preference for being relatively larger than our indices globally, and that is very much by design. So having a weighted average market cap of roughly 60 billion in excess of what MSCI owns, or MSCI EM would currently hold, is very much an intentional position in our portfolios, tied to where we are in the macroeconomic cycle. Also, you'll see that the current valuation metrics would favor growthier categories relative to the more traditional value sectors. This preference in recent years has been a key driver of alpha generation for both strategies. If you go forward to the next page, you'll see the positioning for global small cap. So a couple differences here. One, you'll see that the security count is a little bit higher in small cap. EM tends to be a little more concentrated, with some dominant names that we presently have a preference for being larger weights in the index. So that would necessitate what we consider to be a slightly more concentrated portfolio. But I would say, 50 to 100 names roughly for either portfolio is fairly typical for these strategies. And then also similar to the EM positioning, right now we do have a preference to be larger than the index by design. Some of that is just tied to where we are in the market cycle. Some of that's tied to the appreciation of the names that we've held. We tend to let our winners run. So as we identify a company that's levered to a theme, and in this part of the cycle in particular, you've had some longer term secular trends, which have greatly benefited our portfolios and the investors. And so letting some of those names run up to where we may have bought them at a couple of $2 billion of market cap, and now they're trading much higher. That's gonna cause our overall portfolio market capitalization to increase. And again, very similar to EM, you'll see that the valuation metrics, we're going to lean towards growth. And in the coming slides, you'll see some of the country and sector positioning. And a lot of those valuation metrics are going to be residuals of some of the sector decisions that we've made in portfolios. So here we're looking at where our current country preferences would lie. So Latin America and parts of Asia, particular the components of Asia that would be more IT driven, tech driven, would be where we have allocated our overweight risks, and then being underweight to India, and then what I would consider to be the more government controlled parts of the Chinese economy is where we would have our underweight exposure to pay for those active risks. If you go to the next page, and what I would argue in recent years, sector has been a more dominant factor than country, although that does change over time. But very recently, our preferences for higher quality tech, discretionary names, healthcare names, communication services names, those have been the categories where we've been casting our net for portfolio holdings, and we've been doing so at the expense of having less exposure to financials and some of the other traditional value sectors. I will also note that we do get fairly granular. It's not just making broad sector calls, but within each category, understanding which components of the sector might be attractive or unattractive, and then also understanding how that intersects or interacts with our country level decisions is a key part of the process, as Aaron described. The next couple pages look at the same type of characteristics or positioning for the global small cap portfolio. So you'll see that the U.S. and what I would consider continental Europe to be the largest overweight positions in our portfolio, and Germany in particular, with underweights coming from Japan, the U.K., and to a lesser extent some of the smaller nations within the benchmark. And then from a sector positioning standpoint, you get some differences in terms of the types of companies that we have access to in global small relative to a larger cap emerging markets equity portfolio. So in particular, the exposure to tech names is a little more robust and therefore higher in this portfolio. Healthcare is also a bigger theme, but while we like some of the bigger discretionary names that we can identify in emerging markets, there are fewer opportunities that would be as attractive in the global small cap space. So this highlights how our views are very specific to the choice set that clients are asking us to manage against, and are very much customized and tailored to the space that we're managing. And so with that, I'm going to turn things back to Aaron for our current views on what to expect here in 2020 and some of the key research areas of focus from our team.
Thanks again, Owen. And just to reiterate the point, while we see the snapshot of the portfolios in terms of their valuation characteristics, their size characteristics, their sector and country characteristics, think of all those as being flexible. Those are going to change over time as we see the environment changing. And that takes me back to some of our key considerations this year for 2021. We're optimistic for equities this year, although we do note that sentiment is certainly rising. We would say it's not yet overly optimistic or euphoric, but we're at that point of the market cycle where investors are getting more and more optimistic, and we're heading up that sentiment curve towards what could be the final stages of this market cycle. I don't mean to imply that that's right ahead of us, but at some point in the future, we think where we are now is the later stages of what's been a very long bull market, which might sound a little bit weird given what's on the screen in front of you, that looks at the steep drawdown we had in equities in 2020 and then the recovery. And while technically that's classified as a bear market, just given the magnitude, we would say that the market has behaved much more like this has been an outsized correction versus a true traditional bear market. And that has some important implications for how we look at things from a size, style, quality standpoint. What we see overwhelmingly today is that investors are optimistic as they look ahead to 2021. But generally, they're expecting the market to behave as if we've just started a new market cycle. That period tends to favor smaller, more cyclical, maybe even lower quality companies that tend towards value more than growth. We see that a bit differently. We would say that what you're more likely to see is a continuation of prior leadership, that we were in the phase of the market cycle where higher quality growth companies were leading pre-COVID. That really got accelerated during 2020, largely due to COVID, but we think that's probably going to continue this year. And so it's a fairly contrarian view today that we're not early in a market cycle, even though technically we are. The market is behaving much more like we're later in a market cycle, and that's a period that tends to favor bigger, higher quality growth companies, hence the positioning that Owen shared with you there. Now, what you see on the chart in front of you is just a comparison of 2020 to some prior big corrections. We're looking back at 2018 and 19, 2012 and 13, back in the early 2000s at 2002 and 3. And we noticed something interesting. As we looked at how the market unfolded last year, you obviously had a very dramatic drop tied to COVID. You had a relatively quick recovery, I think a lot faster than many people were expecting. But once we got to those levels of prior highs, it seemed to take the market a while to break out from those periods. What you can see is if you look at prior corrections, that's not at all uncommon. The length of time varies, but usually the market consolidates a bit once you get back to prior highs and then breaks out to new highs again. We think that's exactly what you've seen here recently. The market spent several months sort of toying with those prior high levels. They'd reach them, pull back, reach them, pull back. That consolidation is often then followed by a breakout to the upside, which we saw towards the end of 2020 and has continued here into 2021. So I think all of that is very common. It doesn't suggest that things have come too far too fast or that the market's rolling over again. In fact, that's often what you see following a big downturn like we saw in 2020. Now, economic data has been quite ugly here. If you look at page 24, what you see is just OECD global GDP year over year. And what we're really trying to illustrate here is just the dramatic drop we saw in global economic activity. And that continues today. I mean, here we are in the midst of continued lockdowns. We've seen a resurgence in the virus. And yet equity markets have done relatively well. And I think that has some individuals scratching their heads saying, well, it must be monetary policy that's propping up the market. It must be all the fiscal stimulus that's taking place. We don't see it that way at all. What we think is happening is that the market is seeing that there's a light at the end of the tunnel here. Back in February and March, when the market was so volatile, you had a lot more unknowns than you do today. I mean, you could argue that what we're experiencing with COVID-19 right now is just as severe as what we saw back then. But what we didn't know then were some key features. We didn't know how quickly it spread. We didn't know if we'd be able to develop vaccines and treatments for it. We didn't know the mortality rate. We didn't know what segments of the population would be most affected by it. We know a lot of that now. So even though we're getting a resurgence in the virus and we're getting some renewed lockdowns, you see the market behaving much differently today than it did back then, because the market has the confidence now that there is an end to all this eventually. Maybe it's taking longer than expected, but within the next year or two, we're likely to see a reopening of economic activity. We think the economy can recover relatively quickly, and that's what equities are discounting now. It's not just stocks being propped up by central bank policy or fiscal policy. It's stocks serving their normal function of discounting the future, and there is a brighter future ahead. Now, despite the fact that economic data has been so bad, if you go to the next slide, what you see is that it's actually been better than expectations. What you're looking at here is a global economic surprise index. So the way that these work is it basically takes a number of economic data points and it compares actual results to expectations. And you can see that in the midst of COVID-19, you see a big drawdown there, caught a lot of people by surprise and caused economic activity to contract much more so than people were expecting pre-COVID. But then when you saw immediately after that was that even though data was ugly, it was hugely exceeding expectations. To the highest degree ever, this economic surprise index shot up to the upside. And what that tells you is that sentiment got far too negative in there. There was so much worry, so many unknowns, and that has an impact on investor sentiment where it overcorrected to the downside. Data came in and it was bad, but it wasn't as bad as people had been expecting. And that positive surprise, I think, was one of the keys to the relatively quick recovery of markets. Now, the same has been true for corporate results. If you go to the next page, this looks at S&P 500 earnings quarter by quarter, and it shows you the percent of companies that are beating earnings expectations. And you can see always about 70 or so percent of companies beat expectations, but the last couple of quarters have had historically high beat rates. And again, I think that's because sentiment overshot to the downside and actual results have been much better than people were initially fearing. So fundamentally, we do see better times ahead here eventually. But ultimately, what I think matters for different categories of equities is what does the economic environment look like after we recover from COVID? So if you go to the next page of the presentation, I think what you can see is that even though economies in the world haven't fully recovered and certain segments of the economy are still struggling quite a bit, a lot of those service areas like restaurants and hotels and travel companies and so forth, those remain some of the weak spots tied to the virus resurgence and lockdowns. But if you think of the economy in aggregate, you think of all the different components, I think you could argue that most of the recovery has actually already occurred, whether you're looking at global trade, which you see there on the top left, you look at industrial production on the top right, you look at purchasing managers indexes on the bottom, you see they're maybe not fully recovered, but they're mostly recovered. And I think that has some important implications for style positioning. Because if we were in for a prolonged period of recovery that was going to drive faster growth for a long time, maybe you could argue that's going to put a lot of upward pressure on things like resource prices or interest rates. And maybe that actually would be a lot more favorable for more cyclical value type companies. But we think most of that effect is actually already passed. And as we look forward, we think the economy ultimately settles into slow but steady growth, low inflation, low interest rates, all of that tends to favor your more your more growth-oriented companies than your more value-oriented companies. So we see leadership by those bigger, higher quality growth companies continuing in the period ahead of us. And that's a very different than most managers are expecting. As we look at manager surveys today, overwhelmingly managers are positive, but most are expecting that these years of growth leadership are now ready to give up to value leadership. We think that's a bit premature here. Now, we've had a lot of big political events, of course, in 2020. The US election maybe being the most prominent one, and some of the turmoil in the wake of that is continuing today. But the way I would describe the US political environment is one of near extreme gridlock. And that might sound odd when you think of the fact that we've elected a Democrat to be president. Democrats are now going to be in control of the House and the Senate. And to some, that might suggest political risks are going to go up because all of a sudden you've got one party in control and they can get a lot of things done if they want to. But the fact of the matter is it's actually an environment that's likely to feature a lot of gridlock. We've got very small margins in both the House of Representatives and our Senate. Just one or two defectors in those areas means you can't get things done. And there are a lot of senators, for instance, from relatively conservative states that aren't likely to go along with everything the administration might want to do. So it doesn't matter much whether it's a Democrat or Republican. What we like to see is more gridlock. We would argue that's a more favorable environment for equities. And I think you're likely to see a lot of that in the period ahead. But what you see on the chart in front of you is simply the fact that the political party of the president of the United States really doesn't matter much for equities. What we're showing you here is just a long history of the S&P 500 in this case. The red areas that are when you had a Republican in the White House, the blue areas are when you had a Democrat in the White House. And you see that markets have done well under either type of candidate. And so despite some of the fears out there about higher taxes or less business-friendly policies or those types of things, or people thinking that this Republican administration had been a complete mess and they're happy to see them go. Really, the fact of the matter is that presidents have a lot less power over the economy and markets than people think they do. And really, equities have been able to thrive under both parties. Now, I will say, though, if you look at the next page, that election outcomes can influence the timing of returns. And so what we're looking at here is election years and then inaugural years where you either had a reelected Republican, just looking at the scenario we were facing last year, either we were going to reelect Donald Trump here in the US or elect Joe Biden, who, although he's been in public office pretty much his entire adult life, is a new Democrat, at least in terms of being a new president. And what you see is there are different market reactions at different points of that election cycle based on the type of candidate you're getting. Market tends to react a lot more positively in an election year when you reelect a Republican versus electing a new Democrat. And I think that's because some of the entrenched beliefs about Democratic policies make investors fearful. They worry about bigger government. They worry about higher taxes. They worry about more regulation. And they're less concerned about those things with a Republican candidate. Now, I don't mean to say by any means that one party is better for the market or another, or that any of those candidates live up to the expectation. But I think it's absolutely true that investors believe those things, at least in the midst of that election year, because usually these candidates are laying out their campaign promises, saying they want to do a lot of big things, and that can breed either a lot of fear or a lot of optimism. But what you see is that those tendencies fully reverse when you get into inaugural years. Equity returns are much better in an inaugural year when you've got a new Democrat versus a reelected Republican. And I think that's because investors ultimately come to realize that none of these candidates are going to do everything they said they were going to do. They're all politicians. Most of those campaign promises are going to fall short. And for the Republican, where maybe they had more optimism, that leads to a bit of letdown and lower returns. But for the Democrat, where you had a bit of fear, that breeds some relief there as well and tends to lead to better inaugural year returns. Now, I would mute all of this a little bit this year because markets did quite well last year, despite the fact that you did get a new Democrat elected. And I think that's because some of the uniqueness of COVID and everything that was going on last year, but also it's because, as I mentioned, Joe Biden is a known quantity. He's been in public office for quite some time. It's not as if you've got some fresh-faced new person and you don't know what they're going to try and do. People pretty much feel like they know what they're getting with a Joe Biden presidency already. And so maybe there's a little bit more room for this to lead to a big relief factor, but certainly those inaugural years where you get a new Democrat tend to be good ones for equities. Now, as you look at the next page, what we're trying to illustrate here is the fact that often there's a knee-jerk reaction to political outcomes that can reverse. So as we look back at the 2016 election, I think this is a good example because that was an election that really caught folks off guard. You might recall when President Trump won, nobody was expecting it. All the polling on the online betting sites, most everybody thought that Hillary Clinton would win that election. And so when Donald Trump had a surprise victory, you saw the market react in a very significant way to that. Suddenly there was this expectation that he said he wants to do $1 trillion in infrastructure. He said he wants to cut taxes. He said he wants to lower regulation. He says he wants to do all these things. And the market really believed that he might be able to do that. So what you're looking at here is how big growth stocks performed coming out of that election relative to small value stocks. When the line is falling, small value stocks are doing better. And when the line is rising, bigger growth companies are doing better. So you saw immediately the market started pricing in all of those things. People wanted smaller companies. They wanted more cyclical companies in the expectation that he might actually follow through with those things. But look how short-lived that was. By the time you got to the end of 2016 and 2017 started, already that tendency had reversed and you saw bigger growth companies go on to do well. That's all a long way of saying whatever the market's knee-jerk reaction to a candidate might be, don't necessarily expect that that's going to continue because tied to the gridlock that I mentioned before, there's a pretty good chance a lot of that falls short of expectations. And so the types of companies that maybe have done well here recently based on the notion that we're going to get a big Green New Deal, maybe there's a little bit of room for disappointment there. Maybe all these expectations for more stimulus, popping up smaller companies and value companies, there's a decent chance that some of those expectations ultimately don't come to fruition. Now, maybe in the interest of time, I'll jump ahead just a couple of pages here. One, if you look at 31 that you see there just real quickly, this shows you how big growth stocks do relative to small value stocks over the course of a market cycle. Suffice to say, usually it's small value stocks that do well early in a market cycle and bigger growth companies do well later in a market cycle. And I think as we've seen a little bit of back and forth here, as you can see on page 32, we've seen a number of counter trends along this cycle of big growth outperformance. So as we look back at 2020, although bigger, higher quality growth companies really dominated last year, you can see that there were distinct periods where value companies had their day in the sun. Quite often, those were tied to periods where you had a positive vaccine announcement, or it seemed like the economy might reopen more quickly. But you see just how short-lived those might be. So I think there's this anticipation of investors waiting for this cycle to turn. Every time you get a bit of a counter trend, they think maybe that's the start of it. But what we've seen so far is that's usually led to disappointment. Now on page 33, I think ultimately you need to think about the fundamentals as well. You know, what does the fundamental environment say we ought to be doing outside of just where we are in the market cycle? What's more favorable based on our macroeconomic expectations? And here, I think if you had to point to one economic measure to look at to tell you what types of companies to own, the yield curve is about as good a measure as any. It's certainly not perfect, but it tells you a lot of things about the economy. It tells you how profitable lending is going to be for banks because the difference between long and short-term interest rates tells you what bank net interest margins are going to look like. And so when that yield curve is narrow, that's a headwind to banks. It also tends to take other value categories that are more reliant on bank credit, and that might be less available in that type of environment. And it also implies you're not getting a lot of inflation that would impact things like energy companies, material companies, and so forth. And so what you're looking at here is different yield curve regimes that you see at the bottom of the page there, narrow on the left, steeper on the right. And what you can see is that value stocks have a much more consistent tendency to outperform when you get in a steeper yield curve environment versus a narrow yield curve environment. We think that the yield curve is going to remain very challenged, that you might see a little bit of volatility with interest rates, but by and large, you can be pretty sure central banks are going to keep interest rates at very low levels, and the long end of the yield curve is likely to remain fairly anchored as well for a number of reasons. So this yield curve environment is one that's likely to continue favoring growth stocks over value stocks. So why don't I just wrap up? If we jump ahead to page 36, I want to leave some time here for questions. Just a few key takeaways from the outlook here. We do think we're in the midst of a positive environment for equities. Technically, a new bull market has begun, but as I mentioned, the market is acting much more like we're late in a market cycle versus early in a market cycle, and that has some important implications to it. We're heading up a path of growing investor sentiment. Ultimately, that can get ahead of itself and lead to euphoria and a bubble, but we're not there yet. I know a lot of people like to look at the market today and say, how can these SPACs be doing so well? And how can Tesla be doing so well? And how can Bitcoin be doing so well? And doesn't that suggest that there is maybe too much optimism out there? I think that does suggest that there is growing optimism, but it's not widespread yet. It's not truly euphoric. Although we could get there at some point, we don't think that that's what's right ahead of us here. We think we're in a period of okay economic environment, growing optimism. All of that tends to be a nice tailwind for equities. We think that the economic and market conditions today continue to favor those larger, higher quality growth companies, but we're also very mindful for changing conditions that might start to favor other categories. And certainly we stand ready to make portfolio changes if indeed we think that we're in for a change in leadership here. But right now, that's not our expectation. So why don't I stop there and we can jump into some questions.
Thanks, Owen. Thanks, Aaron. That's great. I'm just going to look through the questions here and see some good ones, and I'll ask you guys. So I'll start with just how do you compare the performance of your funds to equivalent ones in your most meaningful competitors?
Meaning how would we stack up on a peer group basis?
Yeah, I think that's what they're kind of looking for.
Yeah, sure. So, I mean, there's a couple different ways that we can and do look at that, and we're happy to provide you. But one of the most common ways is just looking at, say a database like eVestment, which gives, all asset managers, most asset managers will submit their performance on a periodic basis, usually quarterly, into the database so that, subscribers to that database can evaluate how we stack up relative to one another. I'm happy to follow up with peer group, eVestment peer group for both of these strategies. I think what you'll see in both instances that over the long haul, we have been toward the top end of our peer groups, particularly in global small cap. I think we've literally been in the top decile, if not the top couple percent over the time that we've managed that strategy. But obviously in both cases, we've stacked up extremely well relative to our peers, in addition to beating our benchmarks.
That's perfect. Thanks, Owen. Yep. Another one that I'm seeing a couple of is kind of the underweighting in financials and banks, as well as real estates, and maybe just a little bit more on kind of your outlook in the coming years for those sectors.
Yeah, I can jump in on that one. A lot of that goes back to our expectations for the yield curve environment that I mentioned previously. The reason I focus on the yield curve here, particularly for financials, is because it does tell you so much about the profitability of those companies. When yield curves are wide and there's a big difference between deposit rates and lending rates, that obviously has a very positive impact on banks' net interest margins and their lending profitability. But in an environment where yield curves are flat to very narrow, that can really be a weight on their profitability. So I'll relate that back to our interest rate expectations. At the short end of a yield curve, which represents very short-term interest rates, which are largely controlled by central banks, I think what you've seen is that the response to COVID-19 has been extreme monetary accommodation and very low interest rates pretty much anywhere in the world. Near zero in certain parts of the world, like the US, Canada, is actually negative, Japan, and Europe. And it's very clear that central bankers aren't inclined to change those policies anytime soon. So I expect the short end of the yield curve to remain relatively anchored at extremely low levels today. On the longer end of the yield curve, what we'd be looking for are things like inflationary forces that might drive the long end higher. Not only do you have central banks today, not only controlling the short end, but also through quantitative easing, putting downward pressure on long-term interest rates, which keeps yield curves flat. You're also not seeing a lot of inflationary pressure that's likely to drive that long end of the yield curve higher. And so a relatively tame inflation expectations for, as I mentioned before, steady growth, but not particularly fast growth, should keep the long end of the yield curve well anchored. There are also some technical issues that play into that as well. Not only are central banks very involved in keeping long-term interest rates lower, if you compare, for instance, the recent rise we've seen in longer term interest rates, it hasn't been a global phenomenon. It's mostly been concentrated in Canada, in the US, a little bit in Australia, but in Japan and Europe and most other parts of the world, you haven't seen much of a move in longer term interest rates. But I think that's likely to be temporary. What you're seeing, particularly in the US, which has a big influence on global rates, is the fact that there is a dearth of availability of longer term bonds, just given the way bonds have been issued over the last number of years. As you get around that 10-year maturity mark, there are very few bonds out there because at one point we issued more 30-year bonds, then we stopped doing that, and that's left a gap in what's issued. Most of the new issuance, of course, is happening in very short-term bonds, but there's a very limited supply of bonds at around that 10-year mark or so. So what that means is that scarcity should actually help keep a lid on rates. So not only do you have much lower rates in parts of the world that compete with the US that help anchor Canadian US rates eventually, you also have a dearth of supply there, plus you have central bank intervention. All of that should keep yield curves relatively flat, and that flat yield curve environment is just one that banks tend not to do as well in. But rest assured, we don't have big concerns about bank solvency. We don't have big concerns about banks' balance sheets. I think they are relatively healthy. They're just not as profitable as they could be given the interest rate environment. So we remain a bit less optimistic there, just given our macroeconomic expectations.
Thanks for that, Aaron. Another one is, what is the forecast for the US dollar and how will that impact markets and equity markets?
Yeah, an interesting point is that tied to COVID, a lot of the forces that would drive currency fluctuations, but also forces that would tend to drive differences in country performance have been what I call harmonized here recently. What I mean by that is, if you think pre-COVID, you had different monetary policies in different parts of the world. And now you've got basically one monetary policy. It's central bankers are all in on extremely low interest rates, all in on asset purchases, quantitative easing and the like. So there's been this harmonization of monetary policy. There's been this harmonization of fiscal policy where fiscally there's been a lot of stimulus applied pretty much all throughout the world. And from just a pure economic growth standpoint, you saw most economies crater during COVID. Most are rebounding, maybe to slightly different degrees, but not enough to really drive big differences that would normally influence things like currencies or country performance. Sectors, style decisions have really been the dominant drivers of relative performance differences here. And so as I relate that back to the dollar, most of those forces that would normally drive the dollar to be strong or weak relative to other currencies aren't as impactful today as they normally are. What's really, I think, been the key force behind the dollar here recently has been risk aversion. The dollar is viewed as a safe haven currency. In February and March, as markets are plummeting, the dollar strengthens a lot. And as you've seen markets recover, you've seen the dollar weaken. I think that risk-seeking behavior of investors wanting more safety in the downturn, but now willing to seek more risk, that's been one of the key drivers of currencies here recently. And I think that'll probably continue through 2021 as some of those other forces that I mentioned have indeed been harmonized. So I think to the extent the bull market continues, investors willing to take on a bit more risk, I would expect that's a slight headwind to the dollar, but a relatively modest one. I think for the coming year, you are likely to see things like sector, industry style decisions play a more prominent role than country or regional decisions. And what you've seen here is that the countries that have done best are the ones that have more tech and growth exposure, like the US, like certain parts of China's markets, like Korea, like Taiwan, for instance. And the parts that have struggled are the areas that don't have as much of that. And I think that probably continues here in the coming year.
Perfect. Thanks so much, Aaron. Thanks both Aaron and Owen for joining us today. Just in the interest of time, we're going to wrap it up there. We really appreciate you both coming on behalf of SSQ and all the advisors that are here as well. If you have any last remarks, I'll pass it over to you quickly and then we'll...
Yeah, sure.
Yeah.
Thank you, Stephen. We greatly appreciate the opportunity to help educate you on our approach in both of these products. I do want to offer our resources if there's anything that our team can do to help you address client questions, concerns. If there are any key clients that in interaction directly with me or other members of the team would be beneficial, we're available to you. Please use us as a resource. We greatly appreciate the partnership that we have with SSQ, and really look forward to servicing your clients and you for many years to come. So thank you again for your time, and please don't hesitate to reach out to me directly if there's anything we can do further to assist.
Indeed. Thank you all very much.
Thanks again, Aaron. Thanks again, Owen. Have a great day, everybody.
Thanks.